I'm going to do a couple of things today. I just want to touch upon a couple of other matters related to trade deficits and surpluses and the goodness or badness of them. We're going to talk then about exchange rates, and we're going to move our way away from deficits and surpluses, and we're going to start talking about exchange rate determination today. So today is mostly going to be an introduction to exchange rates and how to think about them and how to work with them. Okay, but a couple of things I wanted to point out. And I don't know if I did some of this or not, so I apologize if I'm going to repeat myself. But one of the distinctions I don't think I made in this class was the distinction between international indebtedness, like whether a country is a debtor or a creditor country, and another term that you might get seen thrown around or you might hear about called the national debt. There's a distinction, a difference between our international indebtedness or our international debt and the national debt. What's the difference between the two? Any idea? Who can answer?
National debt is just what the government owes to its domestic constituents who have taken out IOUs.
Okay, now, when you say it's what the government owes, which government, part of government do you mean?
Federal.
Do you mean only federal, or do you also mean state and local when we measure that?
Just federal.
Are you sure? Okay, you're right then. It's just federal. But those are the kinds of questions you should start asking yourself. It's like, wait a minute, national debt. Okay, does that mean everything? Does that just mean federal? Does it mean state and local? And usually, you're not going to get that explained. You kind of dig deep into an article or into the data to find out what's actually being measured. But generally speaking, when we talk about the national debt, we are talking about how much the federal government has borrowed in the form of IOUs. And those IOUs are issued as treasury bills or bonds. And they're pieces of paper that individuals will collect upon depositing with the government $1 million or $1 billion or even $1 trillion here or there. And the government promises to pay back that at some point in the future along with interest payments. How big is the national debt? Anybody know? Federal IOUs that are outstanding today that have to be paid back at some point between tomorrow and 30 years or so into the future.
20 trillion?
$20 trillion or so. Yes, $20 trillion is owed back. Now, if you ever want to know, well, what is it like at this very moment in time, you might go to this thing called the U.S. National Debt Clock. And there's this website, which will kind of make you go a little bit dizzy. And it tells us it's not quite $20 trillion. It's right now at this moment $19,525 billion, but this is how much it's going up every second.
Wow.
All right, and all they're doing is they're taking the deficit that's estimated for this particular year, and they're dividing it by 365 to get the daily average, and then they're dividing it by 24 hours to get the hourly, and they're getting the second-by-second rate at which it's going up because of the deficit we're running at the federal level today, and then they just make this thing run up at that pace. All right, and they make the numbers change. Now, $19 trillion. Now, I want to talk just a little bit about that because that's a little bit different than our international indebtedness, right? Our international indebtedness means what? Huh?
What we owe to foreigners?
What we owe to foreigners. What's the value of that right now? Net. What's our net owing? What do we net owe to the rest of the world?
Around 7.5.
Exactly. $7.5 trillion. That's our international investment debtor position. We owe about $7.5 trillion to the rest of the world. Now, when it says we, it doesn't really mean the government. It doesn't mean you or me, per se. It means the entire economy, both private and public, everything combined, put together. But when we talk about the national debt, we need something much more specific. It's just the IOUs outstanding to the federal government that have to be repaid to other people in the future. Now, the national debt is almost $20 trillion. That's greater than our gross domestic product right now. And that means it's over 100%. It's about 103% of our GDP. But sometimes you're going to see a number that says our national debt as a percentage of GDP is about 75%. Anybody know why you might see 75% instead of 100%? I see the number right here. It says 100% almost. Do they have the percentage? I think they do. What with the 75%? Anybody know the distinction? Anyone ever read about it? All right, it's presenting a slightly different number. because the 75% of GDP, which is owed back by the federal government, is often called debt owed external to the government. Following sense. We have this organization that's part of the government, kind of, called the Social Security Administration. They collect money from people on their paychecks every week or month. And in the recent past, the Social Security Administration had been running a surplus for many years, meaning they've been bringing much more money in the form of contributions by working Americans than they have been giving out to retired individuals for their Social Security checks. They would bring in billions of extra dollars per year. And what would they do with those extra billions of dollars? They would invest it in the safest thing they knew what to invest in. Namely, they would buy US Treasury bills. Meaning that one part of the government was lending money essentially to the other part of the government. And so about 25% of our outstanding IOUs are owed by the federal government to another agency in the government, which is the Social Security Administration. And so some would say, because that's just a redistribution within the government, it's not worrisome, and we shouldn't really count it. So maybe 75% of GDP then is the better number. Okay, second thing to recognize. A lot of times in a macroeconomics class, intro class, they'll talk about national debt, and economists for a long time have kind of said, you know, the national debt isn't really something we ought to worry about in a big way. Just because the federal government owes back 75% of the GDP to people in the future, does not necessarily cause a drag on the economy for the following reason. It's generally been true that most of the money that the government has to pay back is just going to be paid back to other Americans who have lent the money to the government already. So when the government pays back on its treasury bills, it's going to be taking some money from taxpayers today, and it's going to be giving it back to some other taxpayers today. So it's just taken out of the hands of some people and being put back into the hands of other people, but it's all staying within the US economy, so no big deal. However, to the extent that our national debt is owed by foreigners, that is, foreigners have lent us money, and then we have to pay them back at some point in the future, well, that can be a drag on the economy because that means real resources, real spending capacity have to be given to non-Americans. They're going to spend it in the future and raise their standard of living at our expense. Now, it's all fair and good because, I mean, the reason they get to raise their standard of living in the future is because they allowed us to raise our standard of living today. So it's all fair and good, but it does mean that in the future we have this external debt we have to pay back to foreigners. So all of this means it's worth knowing a little bit about how much of this national debt is actually owed to foreigners. Did I talk about that last time at all? All right, that was the thing I wasn't sure about. Okay, here we have, I think we looked at these values last week. This is the international investment position for the United States for the latest quarter that we have data for, which is the first quarter of 2016. There's our net value, minus $7.5 trillion, net indebtedness to the rest of the world. Here's our total assets that we have collected and we own abroad, which is $24 trillion. And down here is the amount that foreigners have invested and bought of our assets, which is $31 trillion, the difference between the two being the 7.5. But if we look at U.S. liabilities, we can go down into functional categories here, and I want to highlight two values. We've got Treasury bonds and notes, and we've got Treasury bills and certificates. So Treasury bills are short-term. Those are always less than 1 year in maturity. And Treasury bonds and notes are greater than 1 year in maturity. But let's look at the amounts. We've got $5.5 trillion of Treasury securities, which, because this is on the liability side, U.S. liabilities, that means $5.5 trillion worth of Treasury bonds are owed by foreigners, owned by foreigners. And 724 more in Treasury bills are owned by foreigners. So add those two up, and we get to what? $6.3 or so trillion of our federal national debt is owned by foreigners.
Does that mean the domestically owned ones are counted as assets, or do they just figure into it at all?
That's not going to figure into this calculation because this calculation is only measuring things going in and out of the country. So, we're always kind of looking at things and cutting and slicing them a different way and looking at them from different angles. But sometimes some of the data interconnects with each other. So the national debt is part of our domestic calculation, but some of that national debt shows up on this because it's part of our international dealings. All right, so $6.5 trillion worth. About how much of our total national debt is that? Just do a back of the envelope calculation. What would that come out to be about? If we take 20 trillion as our national debt.
Just over 20%.
Hmm?
Is it just over 20%?
Over about 25%, right? So about 5 trillion would give us 25, 6.5 trillion would get us maybe 30% or so. If we take it out of 75%, then we're talking about 1/3. 25, wait a minute, let me think again. If we take it out of 75%, we take it out of about 15 trillion, which is the money owed externally by the federal government, then 6 out of 15 is going to be about 2/3. It's going to be about 30 or 40% is owed to foreigners. Now, all of that means that when the federal government has to pay this back, it's going to have to collect money from U.S. taxpayers in order to make those repayments to foreigners, and that the foreigners, assuming they don't just roll it over and buy more treasury securities, when they cash them in finally and want to spend it, then they're going to acquire U.S. goods. We're going to have to run a trade surplus with respect to that money, give them the goods instead of us consuming them. We get to consume more today, they get to consume more tomorrow. So that does represent an increasingly larger drag on, or burden on the U.S. government and on the U.S. people because of the amount that we have to repay to foreigners. So anyway, the point I'm trying to make is that it's often been said the U.S. national debt is not a big concern because it's not generally owed to foreigners. But increasingly so, up to about 20 to 30 to 40% is now owed to foreigners. So it's becoming an increasing burden, if you will, and is worrisome a little bit for the future. Worth knowing a little bit about. Questions, thoughts? Okay, there's one other issue that's worth noting about our U.S.'s indebtedness to the rest of the world. And again, one of the problems, the big problems that we have to worry about with respect to countries running trade deficits, like the U.S. has for the last 35 years or so, is that international indebtedness can become a problem for future generations when we have to repay it. Now, one of the problems that can arise and that we might worry about is the issue of something like default. What if we can't pay back this in the future? What is that going to mean for our future prospects, our ability to borrow money, to increase our standard of living? All of this could be threatened if we defaulted in any respect on our international debt. And in fact, that's what's happened to countries like Greece. Greece is not able to repay its creditors abroad, and it's being squeezed internally, forced to give over as much as they could possibly bear each month in order to make repayment of a debt which had gotten to over 100% of their gross domestic product. What about the United States? Could we end up in that kind of a situation where we might be fearful of defaulting? The answer on that is likely to be no, and the reason has to do with the fact that the US dollar plays a very central role in the international economy. You've sometimes maybe heard that the US dollar is a reserve currency, the international reserve. And in one context, that's not a good terminology to use because reserves usually refer to countries maintaining fixed exchange rates. And the US dollar is not fixed, it's not really a reserve in that respect. But what they mean by an international reserve is really more that a lot of transactions are conducted in US dollars. International oil transactions, for example. Anytime you're buying oil, you buy oil from Saudi Arabia and you're a Latin American country, Saudi Arabia expects to receive dollars in exchange for the oil, not Brazilian real or something else. They want to receive dollars. Dollars is the currency used for trade of important commodities like oil. But what it also means is that most or much of the borrowing and lending that takes place between nationals of different countries tends to get conducted also in dollars. So most of the debt that the U.S. has outstanding to the rest of the world is denominated in U.S. dollars and has to be repaid in U.S. dollars. Now, we have a certain advantage of having to repay everybody in dollars. U.S. creates the dollars that have to be repaid. And in fact, the U.S. Federal Reserve could pretty much print as many dollars as it wishes to in order to make good on international debts if that ever came to the forefront. So to give you an example real quick, our federal government owes $6.3 trillion to the rest of the world in IOUs. Suppose one day came and we just said, we don't have enough tax revenues, we can't make repayment to the rest of the world, what are we going to do, what are we going to do? Well, in that circumstance, the federal government could go to what is an independent organization, the Federal Reserve Bank, and say, look, if we don't make repayment on this, we're going to lose our good faith and credibility in the world market. We need to pay this. All we would have to do is to go to the Fed, issue some new securities, have the Fed buy them. They would give us the money. The government would then pay the external debt. Point is, we could basically print money to pay back any of our indebtedness at the federal level that we ever might come across. There is no real fear that we would default on any kind of external debt. And that's also one of the reasons why many foreigners are willing to lend us the money, because they know they're going to get it back. Question?
Doesn't that mean that you're paying the amount, but it means that it's not worth as much anymore, right?
Well, you know, in the old days, we would say, yes, that has to come about, because as you increase the money supply, it must have an inflationary effect. But to be honest, in the last 8 years, we've been increasing the money supply like you couldn't believe, and for some weird reason, prices just don't keep going up and the value stays the same. I don't know exactly why. We've got some theories, we'll talk about that later, but maybe that's true, but sometimes it's not. And now we seem to be in an era where maybe that's not. Strangely so. Okay? Yes?
What about fluctuations of other foreign currencies to the dollar? If everyone's repaying in US dollars, how?
We're repaying in US dollars. So it doesn't matter whether their currencies fluctuate or how much they might end up getting, like you're concerned, if the dollar is worth less, we're going to pay them back and we're going to make good on our debt. But they might end up getting money back that's not really worth as much as they had hoped or thought it would be. Now, that means we're good in terms of not defaulting, but the creditors not really happy because they're getting money maybe back that's not worth as much. Exchange rates might work in that direction too, whereby if the currency dollar depreciates significantly, they may end up getting dollars back, but it's not really going to buy them as much abroad. It's not going to work. It's not going to work in their favor, in other words. Let us move on. Next topic of discussion is exchange rates. Okay, here's a website called xrates.com. I used to always use The Economist, but somehow The Economist magazine keeps closing themselves up more and more, and I couldn't even find the data last time I looked. So we're going somewhere else this time. This is a website that gives daily exchange rate data, and right now we want to talk about exchange rates. And here's a list of lots of different countries, and all of these are giving you the exchange rate between the US dollar and that respective currency. So you can see all sorts of currencies that are listed here that are used around the world in different countries. And as you all are well aware, many countries have their own individual currencies, and if you want to buy goods or services there or deal with individuals in that particular economy, you need to acquire their currency in order to make trades with them. Sometimes. To do that, you need to exchange one currency for another, and there will be an exchange rate that prevails at any point in time that will determine the values that one currency trades for another. As an example, the euro is a common currency that the US dollar is traded for, and listed here are two different ways in which we can present the exchange rate between the dollar and the euro. Because there are two different ways to present that rate, it automatically will lead to a fair amount of confusion with working with exchange rates as we work our way through this section of the course. Okay, so I want to highlight a couple of things about how to keep them straight. First of all, why are there two different ways of representing them? That's because we're going to write exchange rates as a ratio. And we're going to put one currency on the top of the ratio and the other currency on the bottom of the ratio. So for example, over here we could mark the dollar-euro exchange rate as 1.12 to round it out. 1.12, and then we would ask, is that dollars per euro or is that euros per dollar?
Euros
per dollar.
It's going to be dollars per euro. Now it's hard to tell on this. It says inverse $1. Like, what the heck does that mean, right? And you'll often find cryptic descriptions of what it is they're presenting like that. But if you come over here, it makes a little bit more sense, because here it's saying 0.89 euros equals $1. So 0.89 euros per dollar, this is the euro per dollar exchange rate. This then must be the dollar per euro exchange rate. It's how many dollars you get in exchange for a euro. So you can represent it one or the other ways. Now, these are related to each other in what way? They're inverses or reciprocals of each other. So if I take 1 in my calculator and divide it by 0.893574, it's going to spit out 1.119101. They're reciprocals of each other. They're just the flips. Other ways of writing it the same thing. Now, the fact that there are two exchange rates to describe the exchange between euros and dollars means we should avoid making the following kind of statement always. We should never say, no matter what context we're speaking in almost, we should never say the exchange rate rises. Because when you say the exchange rate rises, which one are you talking about? One is going up, the other one's going down. And in some sense, you could say the exchange rate rises is always true, because, unless it's staying the same. Because one's going up all the time, and the other one is going down. So here's a better way to talk about it. A better way to talk about exchange rates is that an exchange rate is the value of a particular currency. And written one way, it's the value of one currency. Written the other way, it's the value of the other currency. So let me explain. 0.89 euros is what you will get when you go to an exchange and trade for $1. 0.89 euros per dollar. Is that the value of the dollar or the value of the euro, do you think? It is the value of the dollar. Euros per dollar. We're asking how many euros can I get with each dollar? Or what is the value of the dollar in terms of this other currency? So, the currency that's in the denominator of the exchange rate, in the bottom part of the exchange rate, is always going to be the currency we are valuing with that exchange rate. Euros per dollar, it's the value of the dollar. Dollars per euro, it's the value of the euro. Bottles of water, how do we measure this? How's the value of this measured? We measure it in bottles of water? No, we measure it in terms of something else. What do we measure the value of this in? Dollars. It's dollars per bottle of water. The thing we're valuing is in the denominator. The thing we're valuing it in terms of is in the numerator. With water, it's simple. But with currency, it gets confusing because we got currencies on both the top and the bottom. So the Indian rupee is 66 rupees per the dollar. Is that the value of the dollar or the rupee? Dollar. The Swiss franc is $1.02 per Swiss franc. Is that the value of the dollar or the Swiss franc? Swiss franc. All right, now we want to talk about how currencies change over time. So I picked this website because I can go up here and I can change the year. Let's pick an exchange rate. Let's look at the British pound is a nice one to use. So let's take note of the British pound exchange rate is 1.30. Is that the value of the dollar or the pound? The pound. It's dollars per pound. Write that down. 1.30 dollars per pound. That's today. Wait a minute, before I take this, I'm going to take a tangent. You know, sometimes you'll go into a local bank and you're going to want to trade your dollars for pounds or your dollars for euros. And you walk in and you'll say, what's the exchange rate today? And they will say, well, that depends on whether you're buying euros or you're selling euros, right? They'll have one exchange rate if you're buying euros, and they'll have another exchange rate for you, how nice, if you're selling euros. Why the different exchange rates?
Because they want to make money.
Okay, they're making money. How are they making money on that?
Because they're giving you pay less than, they're not giving you the perfect rate, right? They're going to take a little bit of a cut off.
Okay, so they're going to give you a range of rates. The lower rate, if you want to, let's see if I get this right. So if you want to take your dollars and buy euros, they're going to give you a lower value of the euro when you buy relative to the rate that you're seeing presented on the screen right here. This screen rate might be thought of as the central exchange rate. It's the rate that you would trade at if there was no transactions cost or fee being collected by the trading partner. But you and I wouldn't get that rate if we walked into a bank. So they would change the exchange rate in their favor just a little bit, by 1% or 2% or 5%, depending on who you're trading with. And they're going to give you a slightly different rate than this central exchange rate. And that difference is going to be the fee they charge you. So if, for example, if you took your $100 and went in and exchanged for euros, you're not going to get 100, you're not going to get 89 euros for it. They're going to give you maybe 86 euros for it instead. Okay, so you take your 86 euros and you go back to the same bank moments later and you trade it for dollars. And they're not going to give you $100, now you're going to be down to $90. So you take your $90, trade it, so you could basically stand in the bank all day long, trading back and forth, and by the end of the day, your money would be gone. Right? The bank would have it all, which is why you don't want to do that. But it's also why you've got to be careful when you make exchanges in different venues. They're going to give you different bands around that central exchange rate. If you go to a currency exchange at the airport, the band is often pretty large. And they're going to charge you quite a hefty fee in order to exchange your currencies at that booth at the airport. But if you go to an ATM machine, now the ATM machine is your bank, and what the bank is going to do is oftentimes they're going to give you an exchange rate that is pretty darn close to the central exchange rate on that particular day. Now they might charge you an ATM fee, $2.50 or $3 because you've made an international transaction or something, and you would have to factor that into your cost of making the exchange. But they're going to give you a rate that's pretty close. Now you might get another company or bank that comes along and says, we're going to give you a really low rate, no charges on international transactions. So they might give you that fee is not $2.50 or $3. They're going to say it's zero for you. But you got to be careful because now maybe they changed the rate at which they're trading you for so that they're collecting it on the exchange rather than collecting it on the fee. Banks are tricky in that way. But they're always going to be collecting some kind of a fee from you in order to make a trade. And that's why you won't normally see this central exchange rate. But for the data that's reported, they will generally report the central exchange rate with no transactions cost incorporated. That was my tangent. Any questions on that? Okay. What are we going to do here? We're going to look at changes in the exchange rate over time. So you've written down that the dollar-pound exchange rate is $1.30 per pound. Let's go back a year to 2015, same date. The rate 1 year ago today was $1.55 per pound. $1.55 per pound. So the question I have for you, a year ago it was 1.55, today it's 1.30. Did the pound appreciate or depreciate during the course of the year? It has depreciated. It's gone down from $1.55 per pound to $1.30 per pound. Suppose I wanted to know by how much the pound has depreciated. How would I do it? We would do the following. Percentage change in the value of the pound. 2015 to 2016. See that? No, 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 yes?
Yes.
Yes. Okay. Percentage change in the value of the pound, 2015 to 2016. We take the latest value, which was what? 1.30, right? We subtract out the old value, which is 1.55, right? We divide it by 1.55, the starting value, in order to get the percentage change in the value of the pound over the course of the year. Now, If you're working with a calculator, and sometimes things are going to get tricky, we could write this as 1.30 divided by 1.55 minus 1. And then we can take our handy phone calculator, and we come up with minus 0.161. Or minus 16.1%. What's minus 16.1%? What did I calculate again?
Depreciation
Of the pound. The percentage depreciation of the pound during the course of the last year. Now suppose, with the data that I have in front of me, I didn't ask you that question. Suppose I asked you the following question. By how much did the dollar change in value with respect to the pound during the course of the last year? How would you do that?
You have to do the reciprocal.
What are you saying?
Do the reciprocal. So
Do reciprocal. So how would I write it? So I'm going to write the percentage change, delta for change, in the dollar value. Given the data I have in front of me, is going to be what?
1 divided by 1.30 minus 1 divided by 1.55 divided by
All divided by 1 divided by 1.55. So now you got to take the reciprocals of the exchange rates in order to get it into the value of the dollar. Or you could go on the chart that I was showing you before and just look at the other column. But I usually won't give you both data. I'll just give you one set of data and ask you the question in the other direction. So now I've got to calculate this. Now suppose you were going to plug this into your calculator. Just a quick rule of thumb to make life easy for you. If I were to plug this in, I go 1.3 reciprocal minus 1 point reciprocal. If you've got that function, if you don't, then you got to go 1 divided by 1.3. Then you're going to go minus 1 divided. No, that's not going to work. So you're going to have to put things. Here's how to do it. You take the ratio here, 1.13 over 1.55. And remember that if I've got a fraction divided by a fraction, I can take the bottom fraction, flip it around, and multiply it by the top. So that's going to give me 1.55 divided by 1.30 minus, this is 1 over 1.55 over the same. So that over that is going to be 1. So that's my number right there. It's very easy to calculate. So I just take my handy phone calculator. Is it going to be plus 16.1%? What do you think? If it were, I wouldn't have to do this, right? Take 1.55 divided by 1.3 equals minus 1 equals 0.192, or 19.2%. So the dollar rose in value by 19.2% over the course of the last year. The pound depreciated in value with respect to the dollar by 16.1%. Different denominators in the percentage change, therefore we get a different calculation on the rates. It's not a plus 16, minus 16 kind of thing. It's just the way the math works out. So that means you're going to have to be very conscious of the question that's being asked of you. Am I asking you for the value, percentage change in the value of the currency in the numerator or the denominator? And if I'm asking you for the currency change of the numerator currency, then you're going to have to do the reciprocal of the value you're given in order to calculate the appropriate value. And you will come across that problem or that dilemma in the future. Okay. Any questions on this so far? Yes.
If you ask for the percent depreciation, does it matter if you have negative or positive for 16%?
If I ask for the depreciation, then the sign doesn't matter because I'm going to imagine, well, I wouldn't like to see, well, I don't know, the sign isn't going to matter because I asked you for the depreciation.
So we
If I asked you for the percentage change in the value of the currency, then the value matters, and I would like you to tell me whether it's a depreciation or an appreciation. So rather than just writing minus 10, write minus 10% a depreciation, because that's the terminology we're using for currency changes. Okay? Always good to put depreciation or appreciation when we're talking about currency changes. unless we're talking about fixed exchange rates, but more on that later. And we use different terminology. Next. That's a little bit about currencies. Now, what our objective over the course of the next couple of weeks is going to be is to try to come up with some understandings about how exchange rates are determined in the marketplace. Before I do that, though, I want to highlight the fact that there are several different ways in which countries can set up their currency regime, if you will. All right? And the simple dichotomy that's allowable out there in the world, or that's possible, is to either have a floating exchange rate system or a fixed exchange rate system. So I want to just touch a little bit about the differences between those two, and then we'll come back and we'll talk in a little bit more detail about what that implies or what that means for a particular country. Okay, so first, floating versus fixed. A floating exchange rate is the exchange rate that's determined in a marketplace, a private marketplace. It's the exchange rate that will ultimately equalize supply and demand of currencies at a point in time. A floating exchange rate essentially means that the government is stepping away and letting the marketplace determine what the exchange rate between currencies will be. As a result of that, currency values tend to change over time. The dollar will rise with respect to the pound one day, fall the next day, go up and down, as if it is floating along. Hence, we call it a floating exchange rate. The alternative to that is a fixed exchange rate. And with a fixed exchange rate, the government comes along and mandates the exchange rate that will prevail between its currency and something else. Generally speaking, another currency that it will fix to. And when it fixes to another currency, we would call that other currency the reserve currency for the country that's fixing. So you can get the moniker, the name, reserve currency country, if other countries are fixing their exchange rate to your currency value. As an example, in World War II, or after World War II, we had a system of fixed exchange rates that was called the Bretton Woods system. In the Bretton Woods system, there was a central currency, a reserve currency that was identified, and it was the US dollar. All of the other countries that were a part of the system all agreed to fix their currencies to the US dollar, making the dollar the reserve currency. So you might say, it's because of Bretton Woods that the US is today the reserve currency, except for one little problem. The Bretton Woods system fell apart in 1973. In 1973, the US and other countries, the major countries in the world, stopped fixing their currencies with respect to each other. And in fact, 73 is a kind of a breaking point. Because prior to 1973, in almost all of our modern history, countries had fixed exchange rates, with a few exceptions here or there during interwar periods and at certain times of crises or emergencies. Okay, so there were a few moments in time when we didn't have fixed exchange rates, but for the most part, 1973 and before, everybody was doing fixed exchange rates of one form or another. After 1973, the major currencies in the world have been floating. So the dollar, the pound, the German Deutschmark, French franc, Italian lira, prior to becoming one currency in the euro, now the euro, are all floating. The Japanese yen is floating. The Australian dollar, the Canadian dollar, all of these currencies are floating, being determined by the private marketplace. However, lots of other countries have chosen to fix their currency to one or other currencies out there. Here's the annual report on exchange rate arrangements and exchange restrictions issued by the IMF, IMF.org up here, by the IMF in 2014. And the IMF is the institution that was created in the Bretton Woods system back in World War II or right after World War II to monitor and help maintain the fixed exchange rate system that was implemented at the time. Fixed exchange rate fell apart, but the IMF did not. They're still there, and they still try to do good things for us, some would say. Others would say otherwise. One thing they do is they monitor and keep track of countries' currency arrangements, and they issue this report every once in a while. I'm going to scroll down. That's all the countries in the IMF, by the way. Got it? Okay, don't forget them. Table 2. exchange rate arrangement, number of countries. On the left-hand side, we have a list of different types of currency arrangements that a country might undertake. In increasing order of fixity, I should say non-fixity. So the most fixed currencies of all are the ones at the top of this list, and the least fixed countries are all the way down here, are freely floating countries all the way down at the bottom. So basically, start at the bottom with floating, we become increasingly fixed as we move up on these different measurements. Now, across the columns, we have monetary policy frameworks. We've got the country to which the currency is being anchored to if it's being fixed, and we've got different types of monetary policies that countries may be pursuing. We're not so interested in that right now. We don't need to worry about it. So all we really care about is the differences moving downward. First set of countries is this no separate legal tender, 13 countries. And what that means is that these countries have decided not to have a currency at all. They don't have their own currency. So interestingly, some of you may not know about this, Ecuador, for example, Panama, Zimbabwe, and a few of these others. They all have chosen the US dollar to be their currency. So they use dollars internally. You could go travel there, you could take dollars out of your wallet, you can spend them in the stores. Dollars are the currency of choice and the currency of exchange in those particular countries. Now these countries over here are not part of the Eurozone, but they have chosen to use the euro as their currency. Kosovo, Montenegro, and San Marino. And I don't know what Kiribati and Tuvalu would do, but they might just be, I don't know, Australian dollar. I don't know. They're using somebody else's currency. I wonder who. Now I'm curious. All right, you can't get more fixed to another currency than to use their currency in your transactions internally. So that's the most fixed you can get. Currency board is another term that can be used to describe a fixed exchange rate system. It is an automated system, if you will, where there's no central bank that kind of monitors and keeps track of the exchange rate. Instead, there's a set of organized rules that have to be put into place that guarantee that the exchange rate remains fixed. So currency boards are very fixed, very strong ways of fixing your currency. The most notable country with a currency board is Hong Kong. They fix to the US dollar. Lithuania fixes to the euro using a currency board, so does Bulgaria. Again, it's just another method of fixing exchange rates. Yeah.
But they still have their own currency, they just...
These countries do have their own currency, yes. Conventional pegs. Let's just look at some of the other types of fixed currencies. Conventional pegs, stabilized arrangements, crawling pegs, crawl-like arrangements. I'm not even sure what all the distinctions are between these different types, but they all represent different degrees of fixing currencies with respect to another. Let me give you an example of, where they have China.
Crawl-like arrangement.
There, in a crawl-like arrangement. So China has been maintaining a fixed exchange rate at a very stable rate since 1994 to the US dollar. And then in 2005, a lot because of pressure from other countries to revalue or raise up the value of their currency, they began to adjust their fixed exchange rate on a regular basis. And it started to drift upward in value. The yuan went up in value, and it was being controlled by the government in an upward direction. All right, so that's when China went from what would have been a conventional peg to having either a crawling peg, which they've been denoted from time to time, to having a crawl-like arrangement, which is a little bit more flexible than before. They've allowed their currency to change a little bit from time to time, then they fix it for a while, and they allow it to change a little bit more. So these are examples of how countries manipulate, not quite the right word I want to use, but it's used often, try to adjust the currency value to their liking. And there's lots of different ways in which countries have done that and do that. So just bear that in mind. Pegged exchange rate within a horizontal band. One country, Tonga, is doing that. But sometimes countries put a band of currency rates up with respect to another currency, and they say, we're going to let the currency float as long as it stays inside that band. But every time it gets to the edge, we're going to intervene in some way and try to push it back into the middle. European monetary system, prior to the implementation of the euro in 2000, between about 1979 and 2000, all of the European countries, Deutschmark and the French franc and the Italian lira, they were fixed to each other within a horizontal band They were using that arrangement in the interim before they got to the euro.
When you say the central bank intervenes, how do they?
That's to be learned later.
Okay.
So in about 3 lectures or so, we're going to come back and look at how governments intervene to keep that fixed exchange rate fixed. Now we're just describing. Okay, moving down really quickly and getting to other things. We've got floating and free floating. Those sound very similar to each other, floating and free floating. I think floating tends to be what also is sometimes called in the literature a dirty float, whereas free floating is a clean float. Now a dirty float would be, well, we're just letting the currency float, but every once in a while the central bank comes along and tries to push it one direction or another direction. So they kind of push for a couple of days and then they wait and see what happens. So it's floating, but they kind of give it some pushes one direction or another. That's a dirty float or floating exchange rate. And then free floating is pretty much, we're just leaving it alone and we're letting the private market determine what that rate is, and we're not touching it. And the United States, over here, as well as the Euro or the EMU countries, as well as Australia, Canada, Chile, Japan, Mexico, Norway, Poland, Sweden, UK, all of those are in a pure free-floating environment, and they're intervening rather infrequently, if at all, in affecting their currency values. All right, yes.
This might be a little bit off topic, but in the ones where the dollar is used as their currency, the fixed ones,
The current, they're choosing the dollar to be their currency.
does that mean that, or, well, no, how can I word it? The dollar isn't worth the same, correct? Given that it's in another country, it's a dollar, but you can buy more stuff.
Well, I mean, we have to think about defining what you mean by worth the same and being in another country. You know, it might, you know, the way to answer that would be to find a good that's sold in both countries. So take, you know, a pound of bananas and say, how much does a pound of bananas cost in the US versus a pound of bananas in Ecuador? Now, maybe that's an unfair comparison because Ecuador produces bananas. And so maybe the prices will just naturally be lower there. In which case we would say the value of the dollar is higher in Ecuador because you can buy more bananas. I don't know, really, when you do the comparisons, how the values of a basket of goods would cost in Ecuador relative to the US. But I think we can't infer anything by the fact that they use the dollar that tells us whether the dollar is worth more or less in terms of its purchasing power there. We don't know. No. Yes.
Can we really say, though, that the U.S. is free-floating given the rate of quantitative easing over the past 5 or 10?
Well, you see, but quantitative easing is not an intervention in the currency market.
Okay.
It's an intervention into the monetary market, and it is indeed true that the monetary easing or the monetary environment of a country is going to affect interest rates, and then that in turn is going to affect the exchange rate value in a floating system. So it has a secondary or tertiary effect upon the exchange rate, but we would not call that an intervention to directly affect the exchange rate. Okay? All right, next. What we're going to do is we want to talk now, think about a country in a floating system. So the exchange rate is being determined in a market. I'm going to draw a market on the diagram here. We've got 2 axes, horizontal, vertical axis. We want to think about a market for currencies. Our objective is to try to come up with some theories or some ideas about what elements or what factors influence the value of the exchange rate in the market at a point in time. So we saw, for example, that today the euro-dollar rate is $1.11 per euro. Okay, but at another time, a year ago, it was something different. So what's causing it to float up or float down? Why does the private market move exchange rates up and down on an hour-to-hour, day-to-day, week-to-week, month-to-month basis? What's affecting it? And we want to think about what elements are causing it. Now, to do that, we can kind of think about or conceive of a currency market in the following way. I want to draw a supply and demand curve on this diagram. But I want to draw a supply and demand curve of currencies in exchange for another currency. So I've got to think about how to do that. The way I'm going to do that is to, a supply and demand curve has to have the quantity on one axis and the price on the other axis. All right? So So now I have to think about quantities of currencies and prices of currencies. So let's do the exchanges between dollars and pounds. So let's do the dollar, pound, foreign exchange market, 4X for short. Dollar, pound, foreign exchange. I have to put the quantity of something on the horizontal axis, and actually I have two choices. I can put the quantity of dollars that are traded or the quantity of pounds that are traded. So let's do the quantity of pounds. And it doesn't matter which I choose. I just need to choose one and go with it. Now, the quantity of pounds is actually not a quantity only. It's a value, right? It's the total value of pounds that are being traded in the market on the course of a particular, let's say, day. So this is daily trades in a marketplace. But the price of the pound is going to be the price of the pound in exchange for dollars, and that's going to correspond to an exchange rate. So if I want to put the exchange rate that measures the price of the pound, what exchange rate am I going to use? Dollars per pound. The value of the pound is the dollar per pound exchange rate. So the vertical axis is going to be the exchange rate written as dollars per pound. Now, onto this diagram, I can draw two lines. Upward sloping supply curve, this is the supply of pounds in the marketplace. Downward sloping demand curve, this is the demand for pounds. Let's think about this carefully. Let's start with the demand for pounds. The demand for pounds is downward sloping. The demand for pounds in this market is going to be individuals who are coming to the market with dollars in hand in their bank accounts. They're going to a bank and they're basically telling the bank, who by the way are the facilitators of trades, of currencies between individuals. Banks, if you will, make the market for currencies. They're the ones who are standing there saying, you want to exchange dollars for pounds? Come to us. We'll make a transaction for you. All right, so banks are the market. That's where the action is taking place. And there's only a few international banks that will deal in currencies in a big way, and you have to go to those banks in order to trade dollars for pound generally. There might be multiple banks that do it. We'll talk about the implication of that in a minute. So you've got a bunch of people out there, though, that wish to exchange their dollars for pounds. On a particular day, they are demanding pounds. Now, for them, the lower the price of the pound, that is, the fewer dollars you have to give in order to exchange for a pound, the more pounds you're going to demand. So this is the price of pounds, and as the price of pounds goes down, people are going to want to buy more pounds because your dollar is going to go further and further and further. Right? So demand goes up as the price of pounds goes down. In contrast, the supply of pounds is going to be all those individuals who are holding pounds right now but wish to exchange them for dollars. And for them, supply of pounds is going to go up as the price of pounds goes up. As you get more and more dollars for your pound, people are going to be willing to give up more pounds for dollars on a particular day, right? So the logic tells us upward sloping supply of pounds, downward sloping demand. On a particular day, those two curves are going to intersect each other, and it is at that point that we think will be determined the equilibrium, E-bar, exchange rate between dollars and pounds. So the floating exchange rate on a particular day is going to be determined as that exchange rate that equalizes the supply and demand of currencies on that particular day, or at that moment in time. Now, what causes the exchange rate to float up and down? Well, clearly that's going to come about in this simple conceptual model as anything that's going to cause a change in the demand for pounds up or down, or a change in the supply of pounds up or down. So anything that's going to shift the supply and demand around is going to shift the equilibrium exchange rate and cause the exchange rate value to change. But let's think about what motivates banks. Why will they want to change the equilibrium exchange rate whenever the demand and supply changes in one way or another? Well, to answer that question, let me go through a quick couple of exercises. First, let's imagine just for a moment that the exchange rate is set too low relative to the equilibrium on this diagram. Set at the dotted line down below. At the dotted line down below, the demand for pounds is given and read off of this axis here, but the supply of pounds is over here. In other words, more people want to buy pounds than there are dollars willing to be exchanged for pounds at that particular price. But if we just left the exchange rate at this particular value and made as many trades as we could match up between people, how many trades are the banks going to be able to make? This many trades or this many trades? The lower one, right? Because they can match all of this supply of pounds with this much extra demand. They can match suppliers and demanders of all of that, but they don't have suppliers to match all of this extra demand. So all of this will be unsatisfied extra demand that can't be fulfilled. So they'll only supply and trade that much. And remember, how do banks make their money on currency? By the volume of transactions. So the more transactions take place, the more money that the bank is going to make. So they're not getting as much. If they could raise the exchange rate up to this value, then demand will fall, supply will rise, and the amount of trades will go up. And the amount of money the bank makes will go up. So they have an incentive in that environment to raise up the exchange rate whenever excess supply or demand of pounds exists relative to the supply at a point in time. Same thing is true in the opposite direction if we started up too high. If we started up with an exchange rate up here, then the supply exceeds the demand. The maximum amount of trades that could be fulfilled is going to be the demand level, because that's going to match supply, but they don't have enough to supply the rest. So again, it's going to be too few transactions relative to what's possible. So if the bank wants to maximize its transactions, and they do, want to make as much money on this as they can, they have every incentive to move the exchange rate until it's equal to the level that will give supply and demand equality. Yeah.
So even though this is a macro problem, it still obeys the laws of microeconomics.
Yeah, because we're really getting it down to the micro picture, thinking about at the level of the bank, how are they making and why are they making the decision to move the exchange rate up or down to equalize supply and demand.
So basically they're just using it like any other commodity.
That's right.
Okay.
That's right. Now, there's another thing, which is, what about multiple banks? So you've got multiple banks that are selling currencies to their individual traders at any time. What if in one bank, one day, there's a big demand for pounds and not very much supply because that's just the customers that come a-calling that day. And in another bank, it's very different from that. It's much lower. So the equilibrium prices they would offer to their customers are higher at one bank than they are at another bank. There's a discrepancy between the two. Well, the way that problem gets solved is as follows. Banks watch each other. They watch the rates that are being traded at other banks at any moment in time. And any time that they see even a slight discrepancy in prices that are being offered by one bank compared to their bank or another bank, they will sit and they'll say, oh, right now at this moment I can buy a currency over here at a low price, and if I can move it instantly and sell it at this other bank immediately over there, I can sell it at a higher price. And I can make a profit on the difference in that transaction. 1 second. That is called arbitrage. And in this case, it is called currency arbitrage. Now, arbitrage in general just means buy low, sell high, make a profit on the difference. Currency arbitrage means you're doing that with currencies. You're buying currencies in one location where the price is lower, selling it where the price is higher. You're making that transaction very quickly, maybe over the course of a couple of minutes, and you can make your bank some money in the process of doing that. As a result of that, the mismatch in supply and demand that might lead to very different exchange rates on a particular day get equalized out across the entire universe of traders of dollars for pounds on that particular time, at that particular moment. So all of the banks end up being led to charge essentially the same exchange rate at exactly the same time. And again, whenever the discrepancies do arise, they get leveled out by the arbitrage behavior on the part of the banks. Questions, Phil?
Can't banks also short the value of currencies?
Well, they can do all
or-
sorts of tricky things. Try to adjust and to try to make a profit, yes. Some of those are pure gambling guesses in terms of what they think might happen or how. And that's beyond the extent of this course. We're not going to go down that road and think about all of the different kinds of currency trades that banks might undertake.
Okay.
But we are going to want to talk about what are called forward exchange rates, and we'll get to that in a minute. It's a slightly different phenomenon, but it's one that will matter for us. All right, so we've got multiple banks out there. They're all balancing the total supply and demand for currencies moving in opposite directions at a particular time, and they're adjusting the exchange rate up or down in order to match that balance. All right, and that's going to lead us to the equilibrium or market exchange rate that we see reported on our diagrams and our charts every day. That's the value we think is coming about and why it's coming about like that. But now we want to go a little bit further. We want to think about what's going to cause shifts in the supply and demand curve that might cause the adjustments in the exchange rates in a floating market. All right, now to get to that, we need to think about who the participants in the foreign exchange market happen to be. And in this context, we're going to break them down into two distinct groups of individuals that are coming to the currency markets, that is to the banks, and they're asking to trade one currency for another currency. Now, the first group is we might call traders. So one important group that comes to the currency market every day is people that want to import or export goods and services with other countries. So if you want to import wine from France and you're a U.S. importer of products like that, then periodically you're going to have to go to the bank and you're going to have to take the dollars that you have, exchange them for euros so that you can use the euros to buy the wine from the merchant in France and bring the wine back to the United States. So you will engage in currency trades in order to facilitate the trade of goods. Likewise in the opposite direction. So you're going to have merchants constantly. People in Europe wanting to buy things in the US, people in the US wanting to buy things in Europe or Britain, as the case may be. And that's going to cause some supply and demand of currencies in both directions. So if you are a US citizen wishing to buy pounds in order to buy goods in Britain, are you affecting the supply or the demand for pounds? Affecting the demand for pounds, because you're a U.S. merchant with dollars that is coming to the market demanding pounds in exchange to buy goods in Britain. If you're a British trader wanting to buy American goods, then you would be coming to the market supplying pounds in exchange for dollars so that they could use the dollars to buy the goods in the U.S. and bring them back to Britain. All right, now all of the trader activity is trades that we would record on the current account of the balance of payments. And so that's why we're classifying them in this particular way. The second group of people is what I'm going to call investors. And investors are doing trades not to buy goods and services, but rather to exchange assets, to borrow and lend money, to purchase stocks or bonds or real estate, to trade assets from one country to another. Or in other words, investors are the ones who are engaging in trades that are going to cause activity on the financial account of the balance of payments. They're coming to the market every day and moving money in both directions. So some U.S. investors might decide they want to invest in Britain today. They're going to come to the market and trade dollars for pounds. And somebody else is going to come to the market in Britain with pounds, and they're going to want to exchange pounds for dollars. And so asset trades will take place going in both directions on a particular day, affecting supply and demand. Now, we're going to develop two theories that are going to help us explain the movements in the exchange rates in this particular model. One of the theories is called purchasing power parity, or PPP for short. And that's going to be associated with the activities and the motivations of traders of exports and imports, moving goods back and forth between countries. So the PPP theory focuses on trader behavior and helps use trader behavior as a way of thinking about how exchange rates might be determined. The second theory is called interest rate parity, or IRP for short. And IRP is going to focus on investor behavior. Now, we're going to look at both of these simultaneously, not simultaneous, but in sequence. But we're going to look at interest rate parity first, and it's going to give us kind of a first look at investors' behavior affecting the exchange rate markets. And it's going to turn out to be the more important theory that we're going to address. PPP doesn't work very well for a lot of reasons. IRP is a much more convincing story about what's affecting day-to-day changes in the exchange rate within a country. But I want to move quickly forward and get to the development of the theory we're going to use for investors. Now I'm going to give you the theory, because I really don't have time to get very far into it. So let me tell you why IRP is going to be better than PPP, first of all. IRP is focusing on financial account transactions and the people behind them. PPP is focusing on current account transactions and the people behind them. Now, one of the things that economists or others have gone out and tried to measure is how much currency trades of currency are taking place on a day-to-day basis. All right, and the numbers are rather staggering. So they do the estimates, and they say, okay, well, we know every day there's a bunch of dollars that get traded for euros, and there's a bunch of dollars for pounds, there's a bunch of pounds for euros, there's a bunch of euros for Saudi Arabian riyals, and onward, right? All these trades are taking place every day. Well, it'd be nice to know, maybe, what is the total value of all of those trades that are taking place, say, on a daily basis? Well, the estimates for that I've seen range anywhere from about, $2 trillion to about $5 trillion per day. That's the amount of daily activity on average of currencies being transacted between people around countries. Now, is that a big number or a small number? 5 trillion is big in most people's pockets, but we got to put it in the context of something. So let's put it in the context of something we know about, like, I don't know, U.S. GDP. U.S. GDP is what per year? 18 trillion, but it's 18 trillion, remember, per year, not per day. So we're talking about $2 to $5 trillion of transactions of currencies per day taking place. That's a lot. And we might ask, well, who's doing all of that? And for what purpose? Well, one way we can get at the purpose might be to ask, how much of that might reasonably be associated with goods and services trade? All right, so we could ask, how much trade is taking place between countries on an annual basis and then maybe on a daily basis? And let's compare that to the amount of trades of currency that are taking place. Okay, so we could do that. And I'll do the calculation kind of out loud, and you can write it down if you want. What's world GDP in nominal terms? Do you remember the number about? World GDP in nominal terms is about $75 trillion. Estimates of world trade on an annual basis is about $25 trillion. Okay, so that's 1/3 of total GDP gets shipped from one country to another. All right? Now, let's suppose that you had to make exchanges of currency for all of those $25 trillion worth of goods and services that are being traded every year. We might ask how much of that would be required per day to make transactions. Let's say we split it out evenly across the year. How much total trade might be taking place on a daily basis? Well, we take $25 trillion and divide it by 365, and the answer to that is going to turn out to be something a little bit less than $100 billion. $100 billion of trade, let's say, I'm rounding up, but making the number nice. $100 billion of trade every day. That's a lot of trade. And maybe $100 billion then requires individuals to go to the bank and trade one currency for another to make that possible. $100 billion. But $100 billion is like a drop in the bucket compared to $2 to $5 trillion of currency trades taking place every day. So if you only need $100 billion to engage in goods and services trade, where's the other $2 to $5 trillion almost coming from? Got to be investors. It's got to be transactions that are getting recorded on the financial account of the balance of payments side. So in other words, the activity on the currency markets are just swamped by investor trades. Investor trades are what's motivating the supply and demand in the large part, and thus we can expect that investor behavior affecting the currency values is going to make a big difference, whereas traders, being just a drop in the bucket, are not likely to have very big of an influence over the exchange rate from day to day. And that's why when we measure PPP and we try to see whether this exchange rate theory works pretty well, it really doesn't. PPP does not work very well. IRP, interest rate parity, is going to be a better theory to understand exchange rate movements, and it's going to be the theory that we're going to develop over the course of the next couple of weeks. Next week, actually. Now, I've got just a few minutes, so let me highlight an important stepping stone so I don't have to do it next week. So let's focus on investor behavior and think about what motivates investors to trade currencies internationally or to invest internationally. And I want to break it down into three distinct things that investors care about. Talk about them each in turn. Number one is rate of return. Investors. When I talk about investors, what we really should think of is that we're thinking about the trustees of other people's money. People are putting money into banks, into financial institutions, into their pension plans. They're depositing money with their insurance companies every day. And every day those companies are entrusted with other people's money that they have to do something with. And they're not going to just put it into a safe somewhere and hold it. They want to invest it so that it will grow over time and so that they can pay back their depositors money with a return in the future. Now, in order to give back as much as possible and be successful in your business, you would like to maximize the rate of return on the investments that you're making. So rate of return is an important criteria in determining investment behavior, right? You want to maximize. You want to get the highest rate of return possible. And that's going to be one of our prime focuses on the theory of investor behavior in the interest rate parity theory. Now, rate of return in general means the percentage change in the value of an asset over a period of time. Percentage change in the value of an asset. The reason I port it or classify it that way is because some things, they correspond to the rate of return we're familiar with, and sometimes, well, it's not always a general determination. So let me tell you what I mean. Suppose you put your money into a savings account at the bank. And let's suppose the savings account gave you the enormous interest rate of 5% per year. So you take $1,000 and you deposit it in the bank at the beginning of the year. Your asset, which is the savings account, is worth $1,000. If you let it stay in the bank for the entire year and you take your money out at the end, you're going to have $1,000 plus $50, which is the 5% interest attached to it. If you calculated the rate of change of that asset, it's $1,000 to $1,050. Calculate the rate of change, it's 5%. Now, 5% corresponds to the interest rate on that deposit, right? So sometimes the rate of return and the interest rate are one and the same. Okay? And so that's the easy way of understanding rate of return. But sometimes the asset you buy doesn't have an interest rate on it. So for example, if you buy a stock in a company and you pay $20 per share for that company, you buy one share, to keep my story simple, and the value of that share goes up from $20 to $21. Let's make it $22 because that's a nicer number, easier to calculate. It goes from $20 to $22. Then I sell it. Well, now I'm going to make $2 on the $20 I invested. That's a 10% return. My rate of return is 10% during the time that I was holding it. I don't have interest on it. I just have that the value of my asset went up by 10%. Okay? So sometimes I'm going to measure rate of return using interest rate. Sometimes I'm going to use something else. Depends on the asset that I'm purchasing. But it's always going to be percentage change in the value of that asset over a period of time. Now, what we're going to do in this course is we're going to consider an individual investing in a domestic asset with a particular interest rate associated with it, and then investing in another asset abroad, in another country, that has another interest rate associated with it. And we're going to see how the individual has to make that decision. But there's two other things that investors care about. Safety/risk, depending on whether you want to look at it negatively or positively. Safety. The safety of an asset is, well, how likely is it going to be to hold on to its value and generate the return that you expect in the future? If it's likely to do that with good probability, then it's safe. If it's not likely to do that, it's very risky. Investors want to minimize the risk on their investments and or maximize the safety of their investments to assure that they're going to get what they expect to get. That's a second very important consideration that investors care about. The third thing, because I'm running out of time, is the liquidity of the asset. And liquidity refers to the speed with which you can convert your asset into a spendable form, like into cash. Cash, being already in a spendable form, is highly liquid. You can spend it tomorrow, usually, or today. Real estate, as another example, is not very liquid. So if you're an insurance company and you put all of your money into real estate and then have suddenly a bunch of claims come due because of a catastrophe somewhere, and then you have to sell all that real estate in order to get the money to pay that, well, you've got a problem. So that kind of an investor is going to be very concerned about how quickly they can convert their assets back into cash without taking any penalties or losing too much money. Liquidity will matter to investors. In general, investment decisions is trying to manage these concerns. They're trying to maximize the rate of return, minimize the risk, and achieve an adequate or appropriate level of liquidity for their clients so that they can do best for their clients over the long term. So that's what investors' decisions and goals ought to be. We're going to take that list and we're going to use it to develop a theory of exchange rate determination in the next class, and we're going to work with that.